One was, could you explain a bit more about the productivity downgrade? How far did you go back? What were the main points that you addressed when you looked at that? And Tom, I wondered, Richard mentioned about the effect of inflation and earnings on your upgrade. Is that a net figure? Does that include what the government has to pay out on extra inflation and earnings on the public sector? Or is it a gross figure? And also, the amount of money that the Chancellor says she's going to get from tax avoidance at the back end of the forecast, is that realistic?
Thanks, Philip. David, on the productivity downgrade.
Yeah. I mean, this is a judgment on what you might call the underlying or trend rate of growth of productivity. So it's the underlying rate, stripping out things like cyclical position of the economy, the ups and downs, or in fact, the impact of shocks, which might have a temporary impact and will certainly show up in measured productivity. If you just take total output in the economy, GDP, divided by how many people are working or how many hours they're working, that's a mixture. How that moves over time is a mixture of what you might call the fundamental trend rate and being buffeted around by shocks. We've had a lot of shocks in the UK, and going right back to the financial crisis. So I think it's a pretty difficult judgment to make, because you can't just take the published estimates of productivity, which themselves are subject to mismeasurement on GDP, and particularly on labour input, where there have been problems in the UK. You can't just take those measures and say, well, let's draw a straight line through the last 4 or 5 years, and that's what the future's going to look like. That would be a pretty poor estimate of the sort of underlying rate. And I think it's because of the impact of shocks that you'd expect to have a short-run impact, which could be very negative, but to be somewhat temporary, that we kind of stood back from making an adjustment in the aftermath of COVID or the energy price shock, because they were, I think, very much clouding the picture on what was happening to underlying productivity. I think now we're, what, 5 years on from COVID, and a couple of years on from the really very big changes in energy prices. And we've now got some alternative measures of labour input, which might correct some of the defects of the labour force survey. It's possible to look back over the last couple of years, after a lot of those shocks have probably played out, a period where we'd hoped that there would be some recovery in productivity back up to a trend which had been driven down in the measurements by the shocks. That didn't really seem to be happening. And I think now we've had long enough past after any impact of the shocks of COVID and the energy price shock to be able to look at the last couple of years where there's been some growth in productivity, but it really hasn't shown a bounce back to a much higher level, which our forecasts had been expecting. So that was perhaps one of the major factors there. We also look back over long periods in history about what happens when there are shocks and recoveries from them. We've also taken account, I think, of a couple of things that have come along really very recently, one of which is the rather worrying trajectory on sort of globalization and trade, and more narrowly the impact of tariffs on the UK from the US. It's hard to see that as anything other than a somewhat negative factor on productivity, offset a bit by the hope, anyway, that AI developments might boost productivity a bit. And we've done quite a lot of research on trying to work out just how positive the AI effect might be. And there's a report that we've put out alongside the EFO on that and the other parts of the supply side judgment. So somewhat long-winded answer, but it deserved a long answer, because it I think was a judgment that because of the measurement issues, sort of rushing into it too quickly without stepping back and trying to look at really the underlying trends here meant that one could, well, I think we wanted to avoid sort of being somewhat trigger happy in the aftermath of those big shocks and saying, well, that's now the new long run low rate of productivity growth. But it's been long enough after those, and we think that it's right to make a downward adjustment.
And Tom, the two questions for you were on the impact of inflation and earnings on public spending and the yield of measures targeting tax avoidance.
Yeah, thanks. So the number that was in Richard's presentation for the increase in our receipts forecast due to higher inflation, which is 14 billion estimate, that is just the impact on tax receipts, and that is quite a large number because income tax and NICs are a very big proportion of the government's tax take, and with frozen tax thresholds at the moment, they are very sensitive to the forecast for nominal earnings. There is, as I think you are asking in your question, a cost to the government from higher inflation through higher benefit uprating, some higher debt interest costs. It also increases the pressure on departmental budgets. That doesn't show as a fiscal cost because the Treasury sets departmental budgets in nominal terms at spending reviews, but it does mean that higher inflation means sort of more pressure within those budgets that the Treasury has set. On the tax compliance question, so we have some analysis in the report on this. We look at, in a lot of detail, all of the individual tax compliance measures that the Treasury puts to us to try and ensure we have a reasonable central costing of the yield that they will generate. But we do underline that there is a lot of uncertainty around those costings because they do depend quite often on how the targeted group of non-compliant taxpayers will sort of respond to those changes. And we do typically build into those costings an assumption that the kind of yield from the measure will tail off over time because those non-compliant taxpayers will adjust their behaviour in response to the measure. We also look at the overall, what is known as the tax gap, which is the difference between the yield that HMRC receives and the sort of theoretical amount of tax there is out there to collect. So it's a measure of non-compliance. And test whether the forecast for the tax gap, taking account of all the measures that the Treasury is introducing, looks reasonable. What that shows at the moment is, well, if you look at the past, the tax gap came down quite significantly during the 2010s, which in large part was probably due to measures that HMRC was taking. It's been relatively flat since 2017-ish. And on the basis of the measures the government introduced at the last budget, in this budget, we forecast that it will fall by around a percentage point. So a similar sort of fall to the one we saw in the 2010s. We think that's a reasonable central estimate and reflects both additional resource that HMRC is putting into non-compliance and, as I say, a large number of measures targeting specific areas of non-compliance. But there's certainly a lot of risk around those estimates.
Does that mean I'm right to assume from your answer on the first point that departments will absorb these extra costs? There's nothing I'll find in the report that says where these costs will, the net cost. It's just something that they're going to have to absorb in their existing comprehensive spending review finance. Yeah.
So, I mean, the Treasury made some small changes to the allocations that it sets at the spending review, but they are mainly to fund new policy announcements that the Chancellor made either at the spending review or in the budget.
We're going to take one more question from the room for now.
Paul Wallace, in terms of fiscal consolidation, isn't this a make me chaste but not yet budget, and just how credible is it?
Richard.
So it does push the weight of consolidation back later into the forecast period, and it roughly shifts the consolidation back by a year in the first few years, but then does more of the consolidation in 2028, in 2029, 30, and then 31, which is the extra year added onto our forecast period. That's because there's quite a lot of extra spending in the near term, both in our pre-measures forecast and also in the post-measures forecast, and then the tax rises don't start raising revenue until later in the forecast. To some extent, that's sort of in the nature of policy making, which is that spending pressures are always up front. Taxes only generate additional revenues when you put up the rates and activity rises. So, but it does follow a pattern of government's fiscal consolidations, which is they have tended to slip. We've seen successive governments have plans for reducing the deficit to roughly the levels that the Chancellor is trying to get to by the end of the decade. And for various reasons, both shocks as well as new pressures emerging, the deadline for that consolidation slips. I mean, one thing to say about this Chancellor's fiscal framework is that one thing that she can't do with her current balance target is for the moment slip the deadline. It is 2029-30. That's what the deadline was in our March forecast. That was what the deadline was in her October budget last year. That's still the deadline this year. It's not until it becomes the third year of the forecast that it starts to roll forward again. And so for those reasons, at least for the next this budget and the next, she's wedded to getting the deficit, the current balance, down below, to a positive number by 2029-30.
Thank you. Right, we will go to some questions online now. Quite a few coming in. We've got several questions, Tom, on the new mileage-based charge on electric cars. Paul D asks, will pay per mile only be applied to newly registered vehicles? The next one is, with the new electric vehicle price per mile of 3p, is this going to encourage drivers away from EVs? Also, why are fossil fuel hybrids 50% less at about 1.5p a mile? And then finally, will the new EV tax not encourage the use of mileage defeat devices, which I think I understand what that means, mileage defeat devices, especially as they don't need an MOT for 3 years. So I'll leave you with those.
Yeah, a number of questions there. So the new charge will apply to all EVs. On the question of why a lower charge for hybrids, that's a question for the Treasury. That was their policy choice. In terms of will it reduce sales of electric vehicles, we do assume that essentially because of the higher lifetime cost of running an electric vehicle, it will reduce sales compared to without the policy. The government has also introduced a number of other policies at the same time which are acting to increase the incentive to purchase a EV through grants and through some other changes to taxation. So that does offset some of that effect. I mean, there's also quite a lot of uncertainty about how this will interact with the electric vehicle mandate, which is a requirement on manufacturers to sell an increasing portion of their vehicles as electric vehicles. So overall, we estimate that the impact on sales will be around 100,000 lower sales over the next few years than otherwise would be the case. That is very uncertain estimate, and as I say, it depends on how exactly manufacturers respond and how the car purchasers respond.
And mileage defeat devices?
Well, I think there was a set of actions, if I remember it, in the alongside the policy to try and address non-compliance, but I don't have more details on that specific aspect of it, I'm afraid.
Thank you, Tom. David, could you explain why this budget is a near-term boost to GDP?
Well, because it's a bit of a fiscal loosening in the near term. There's a fairly substantial spending increase over the next couple of years, and it isn't really, as has been discussed already, it isn't really until a bit further down the road that the big increase in taxes comes through and that there's some reduction in departmental spending, anyway, toward the end of the forecast horizon. So it's a slight, what you might call a sort of old-fashioned Keynesian demand boost to the economy in the very near term, and it pushes the growth rate up a little bit. Too late for it to have an effect this calendar year, but next year a little bit. It's kind of fairly muted, that impact, and in fact, if one looks at the sort of forecast for GDP, our central forecast anyway, about something that's pretty uncertain, but the central forecast are that you get, pretty close to 1.5% growth in real GDP in the UK from now on until the end of our forecast horizon over the next 4 years. And that is in line with our assessment of the growth in potential output in the UK, which is productivity plus increases in the labour supply. So actually our forecast is very sort of flat line-ish in terms of rates of growth of GDP.
Thank you, David. Richard, Rob Woodward asks, you've been critical of capping the role of the OBR previously and scrapping the biannual check on fiscal rules. What is the biggest risk from the Chancellor's proposal today?
So the Chancellor's announced today that they're going to amend legislation to mean that the fiscal rules are only assessed once rather than twice a year, but also makes it clear that we'll continue to produce 2 forecasts a year, full 5-year economic and fiscal forecasts, which will include forecasts for the fiscal aggregates included in the Chancellor's fiscal target. So there'll be no loss of transparency from the perspective of the public, Parliament, and taxpayers having an understanding of the state of the public finances and the outlook for them. I think the implication is that there won't necessarily be responses from policy to our forecasts in the spring. It'll be more of a kind of health check on the state of the public finances and on where the economy is heading, and a waypoint on the way toward an autumn budget, which will be the focus of fiscal policy making. And I think, as I said in my presentation, the headroom that the Chancellor's now built up against her fiscal rules of around 22 billion pounds is around the average forecast to forecast change between our forecasts, which also means that there's a better chance that the rules are still being met in our spring forecast than when she had lower headroom.
Thank you, Richard. A question probably for you, Tom, on the 2-child benefit limit. What behavioural changes have you modelled for the removal of the 2-child limit? And that's from Jordan Byrne.
Thanks. So in the estimated cost of that measure, there is an assumption that around 25,000 additional families claim universal credit that are not currently claiming universal credit because of the increased generosity with the 2-child limit removed. That is the main behavioural assumption that's made in that costing.
Thank you. Sorry, I may be coming back to you, Tom. Delphine Strauss asks, from the FT asks, the OBR is forecasting big near-term increases in spending and later increases in tax revenues. Mm-hmm. How uncertain are the revenue forecasts? And what is your assessment of the effect of the salary sacrifice changes at different earnings levels? So that's 2 questions there.
So, I answered the question earlier on the increase in spending, which is around £22 billion. And actually a lot of that is already increases that we're seeing in spending this year, and then is kind of maintained over the forecast period. And as I said, it's a combination of higher spending in local authorities, in welfare, and in debt interest. The increase in the forecast for tax receipts is largely driven by the higher earnings and inflation forecast, and that therefore builds up over time. And in particular, we've got a higher wage forecast next year, and so the increase in receipts kind of starts next year and then grows over time. I mean, in terms of, well, first of all, on salary sacrifice, we do expect that to mainly fall on higher earners. It tends to be higher earners who use salary sacrifice, and it is also the case that with the £2,000 cap, that also means that it's more likely to affect higher earners who put more than £2,000 into their pension through those sort of schemes. I mean, in terms of the risks to the tax forecast, I guess a couple of things to say. One is that the increase in the tax to GDP ratio over the forecast takes the tax to GDP ratio to what would be a record high for the UK, and around 5 percentage points higher than it was before the pandemic. That is largely driven by increases in personal tax. A lot of it is driven by the threshold freezes, but also other changes in personal tax. And that does affect a very large number of taxpayers, and therefore the yield from it is more certain to the extent that the kind of behavioural response is easier to estimate, but it is very sensitive to the forecast for earnings and inflation. And what we've seen over the course of the past few years is that these threshold freezes have raised a lot more than we originally anticipated, because inflation and earnings have been so much higher than was expected before the energy price shock in particular. So there is still uncertainty around that. Another chunk of the increase in the tax GDP ratio is driven by capital taxes, so capital gains tax, stamp duties, inheritance tax. Those do tend to be more uncertain in terms of the kind of behavioural response that individual taxpayers might have to those tax changes, and also to the value of assets, equity prices and property prices in particular.
Thanks, Tom. I just wanted to check any more questions in the room. This lady here again.
Thank you. Yeah, I just got a couple if that's okay. So Rachel Reeves said the damage from austerity and a chaotic Brexit and the pandemic were worse than we thought. Is she right to blame everyone else? And then secondly, I was just hoping to ask, when did you tell the Chancellor that stronger wage growth would boost receipts? Was it on the 31st of October in the final pre-measures forecast?
David, do you want to take the first of those?
I think the judgment on productivity really now is really about looking back over the period since low productivity growth began. And that's really, there's a kind of pretty clear watershed around the time of the global financial crisis, 2000, which is what, 17 years ago. And I think our story there is that you would expect very big shocks like that to be very disruptive of output. I mean, the banking sector collapsed in the UK, pretty much. That's what happened. Financial conditions extremely difficult for households and for companies for several years, not just a few months after that. And what we've tried to do is kind of look through those big shocks, and we've had two more recently, as I was saying earlier, to try and discern an underlying path for productivity. And it's been affected by not just those shocks, it's also been affected by Brexit, which we'd already factored in to a large extent and taken a big chunk off, frankly, UK potential output down the road, and that had a substantial impact on our productivity forecast. We made that judgment back in 2017, which was the last big downgrade. It's difficult to know quite what the main factors have been in what now looks like a much more sustained reduction in the growth of productivity than just the lingering effects of some shocks which are all going to go away. And as I said earlier, we're now far enough past the latest set of shocks for us to think that it's just simply too optimistic now to expect any kind of return to the somewhat higher rate that we'd had in our assumptions more recently. Quite what the factors are, one can point at a whole range of them, and there's been an awful lot of academic work on this. Some of them reflect a sort of pessimism that really applies to most rich countries, because there's been a slowdown in productivity, pretty much across the board. I mean, there's a view, Robert Gordon wrote a very long book about this a few years ago, basically saying that we discovered all the things that were really strong boosters of productivity, and sort of get used now to going back to a lower rate of productivity than we've seen over the last 150 years. So his view was that it was nothing specific to the UK. It was just about technological advance slowing down. We've discovered lots of the things that generated the high productivity we've seen over 150 years. Difficult to know whether that pessimism is justified. In our own assessment, we at least looked at one thing, which is the sort of optimistic side of that, which is that AI is the new, the ultra-optimists would say, it's the new electricity. We're much more guarded in that, but we took account of something at least on the upside, which is really why our downgrade in productivity growth in the bigger picture of history is actually not that large. It's not trivial, but neither is it sort of changing the whole trajectory of the UK economy. It's a 0.3 downgrade from 1.3 to 1%.
And we also had a question on when you told the Chancellor about stronger earnings in the forecasts.
Yeah, so as we set out in the foreword to the document, one of the things which we try to do is make sure that our forecasts are as stable as possible over the course of the forecast exercise, so that it's only really new information that's available in the outside world that changes our view of things. That's one of the reasons why we do these summer supply stock takes about what we think of the underlying trend rates of productivity, as well as try to get other macroeconomic judgments into our forecast in early rounds. Unfortunately, I can't go into the details of all the specifics of our forecast in every round, but you get all the detail when we do publish our EFO at the end of the process.
We'll take a question here.
Thanks. David, you mentioned Brexit just there. There's been a recent paper that has come up with much bigger figures for the impact of Brexit, between 6 and 8% lower GDP relative to the counterfactual. Have you taken on board those estimates? Do you stick by your 4% figure, which you came up with originally?
Yeah, it was a serious piece of work by Bloom and other authors. I think there's been some other serious bits of work that have come on the other side of our 4%. That's just the latest in a bit of an industry of trying to work out what the effect on productive potential of the UK is. We didn't feel that latest study was so utterly convincing that the many studies on which we base the 4% number should now be, in a sense, put to one side, and the latest one, let's give that 100% weight. So we haven't made an explicit adjustment for that in the latest productivity forecast. I mean, we'll see how things play out. It's a pretty difficult judgment to make, and that paper uses different techniques, one of which, from memory, is to kind of create a sort of doppelganger of the UK economy by looking at many other countries and trying to sort of create an alternative vision of the UK which didn't have Brexit, and by stripping out things that were in common with other countries. Those kind of doppelganger economic experiments are very difficult to get right. So I think it would have been a bit premature of us to say, wow, there's a new study come out which said the answer is 6% or 7% or 8%. Let's jump and change our forecast.
Can you just wait for the microphone?
Sorry,
Thank
in
you.
your judgment, is the 4% deterioration, is that now in the current economy, or is there still a bit more to come in coming years?
I think there's still a bit more to come, because we made the judgment that this hit to productivity would play out over a fairly extended period, and it was over that period that the trade intensity of the UK would decline. So, and it was a judgment made, where are we now, 20, 25, I mean, sort of 5 or 6 years ago, when it became a bit clearer what the leaving agreement was. So it's certainly got some way to play out, and I don't think the whole of that effect has yet played through. Thank you.
Final chance in the room. Okay, we've got a few more minutes for questions online. Tom, Suchan asks, who is bearing the greatest burden of the tax rises in this budget?
I set out in answer to the previous question the increase in the tax GDP ratio over the forecast, and also the main additional yield that the Chancellor has raised at this budget is coming through personal tax increases, the personal tax threshold freezes in particular, which obviously apply to anyone who is working, and then after that there are a wide range of other tax increases which are aimed at particular groups of taxpayers.
Thank you. A couple of questions for you, David, on different topics. The first is your inflation forecast is 2.5% for 2026, but this did not include the downside surprise for inflation in September. had the OBR used that, would that imply inflation returning to target earlier in your current forecast? And a question from Delphine Strauss at the FT. The forecast for real household disposable income has been cut. How does growth over the coming years compare with historical levels?
On real household disposable income, the central forecast is for a period of very low growth in real household disposable income per person, per capita in the UK. I mean, after this year, looking forward, it's running at about 0.2, 0.3% a year. I mean, that's substantially lower than the long-run average in the UK. And it's a disappointingly low number. It reflects partly the productivity judgment, and partly that the tax takeout of GDP, which obviously is a factor behind disposable income, is rising, and there's some pretty big tax increases down the road. So it's hardly surprising, given those things, that you get a pretty low growth in real household disposable income. Again, on the central forecast, and there are risks either side of that. On inflation, if I remember correctly, the September figure, the question was about the September figure, yeah. I think. Well, we certainly, so that would have been published in October. I mean, we certainly had access to that, and we're going to adjust our forecast in the light of that. So I think I don't think it's quite right to say that we ignored that. Obviously, 1 month's number can jump around for all kinds of reasons. We certainly also took account in projecting forward into next year. I think the biggest effect comes through of the sort of reduction a bit in the price level, and therefore the inflation rate in 2026 from some of the budget measures. But I suppose the story of the forecast is that relative to where we were in March, there have been somewhat higher inflationary pressures, and therefore it takes a bit longer on our central forecast anyway for consumer price inflation to get back to the target. But it does get back there. It's now during the course of 2027 rather than next year.
Thank you. And we've got time for just one more question. And it's going to be from the room in a late twist.
Anna Gross again from the FT. Why did the planning and infrastructure bill and also some of the employment support measures not boost your GDP growth forecast, which I think the Treasury was very much hoping that they would?
I'm going to ask you to take that one and wrap us up, Richard.
I mean, the short answer is that they're still going through Parliament. Some of the important details are yet to be specified, in particular for employment rights, the probation period, which is one of the key details to understand, to estimate its impact on things like labour supply and business employment decisions, are things which are yet to be specified. They're going to be in secondary legislation, so we're going to have to wait the details on those bits of legislation before taking them into account in our forecast.
Thank you, Richard, and David and Tom. So I'm afraid that's all we've got time for this afternoon. Apologies to those whose questions online we didn't get to. Do get in touch with us, and we're very happy to follow up afterwards to try and answer your question. And I will wrap up by saying thank you to all of you for joining us today, and we look forward to seeing you at our next event in the new year.